all of us programmed to think that there's this one key variable in the world that will always be low, or going lower and stable. Yeah. And guess what? It isn't anymore. So we don't know what normal is. Normal may be 3 now. It may even be the case that over the next 5 years or 3 years that central banks everywhere start to move away from explicit inflation targets at 2. They won't tell us directly that they're going to do it, but the new normal may be higher.
So we've got this plateau now, or the plateau effect, where it's like climbing the Himalayas. Instead of coming back down again, you just stay up there. Yeah. And we know there's not a lot of oxygen. And it feels like that's what's happening on markets. The oxygen has just been sucked out of the market because of this very tight scenario. What do you do then? Is there a weathering the plateau effect now on stocks?
Yeah, I think the plateau is the key thing here. So, the last 2 months really in markets, we've started to see in equity markets, which is my focus, we've started to see that higher for longer has become a really key determinant of return. So rate sensitive equities are starting to get hurt. And I guess one of the sort of key places you can see that has been regional banks in the US. So last week we had a ton of US regional bank results, and all of them were reporting basically that net interest margins are being squeezed. And net interest margins are being squeezed because banks are now having to pay for funding in a way that they didn't have to do before. That is a classic higher for longer problem. You roll back to SVB in March, the Fed stepped in with new term funding windows. They saved the regional banking sector from a deposit run. Everyone breathed a sigh of relief. Regional banks rallied a lot. But actually the story wasn't about whether there was sufficient funding. The story was about how much that funding costs. And I think whether the Fed cuts 50 bips next year or not, the truth is, to your question about new normal, we're not going back to zero. And as long as we're not going back to zero, we've got a whole swathe of companies out there that have been built in the last 30 years on the assumption of this stable variable that isn't stable anymore. And they have to adapt to a world where things cost more. So interest rate sensitive businesses are a really vulnerable place to be.
So how do you find opportunities then at this point? Because we've had 3 months of correction. So the pullback we've seen has happened on the S&P, it's happened on the NASDAQ, and the Dow slightly to less extent. So how do you look at getting back into some of the quality names out there that investors are saying are now priced a little bit cheaper than they were? Is this the entry point we're seeing?
So we don't really think about that so much in terms of the market beta. We're thinking about where's the stock or sector opportunity. Our job is selection rather than just timing whether to buy the beta or not. I think the really interesting thing is if you think about that impact of higher rates, there's been a pretty indiscriminate effect on anything that's mechanically interest rate sensitive. So you take banks, which I've already mentioned, you can take companies with near-term refinancing risk. They've been hit hard for obvious reasons. You can also take companies that are what we used to think of as bond proxies. So things with really stable cash flows that run out a long period of time, long duration equities, they've been hit mechanically with rates going up. So things like utilities and real estate. My view would be that I think it's pretty likely that next year we're going to see materially slower growth. I've been saying that for 18 months, so I'm a bit of a broken record. I'm probably not alone. but I think that if that scenario starts to play out next year, higher for longer really starts to eat into consumers and employment, then you have an opportunity to pick between the interest rate sensitive businesses that have been hurt because rates have gone higher. So some of those are going to stay weak because financing costs stay high and the businesses are not strong.
Such as real estate, for instance. I mean, it doesn't feel like we're at the end of it. We were talking to Skanska this morning about having to write some impairments into the books because of the valuations that have been impacted on residential and construction. I mean, Anders couldn't give us an answer as to whether they're done. This is just going to keep on happening on a quarterly basis. That's a problem, right? If the valuations are still going to fall from here, we're not done yet on the real estate story.
Depends on the asset. If you can find a business with a clean balance sheet with low loan to values, and there are plenty of them out there with good assets that are highly in demand, people that build industrial sheds for logistics businesses, there are certain niches that are highly in demand. So I think your point is really well made. There's an indiscriminate effect at the moment to say real estate equals bad. Through that wreckage, if you can find the businesses that have been thrown out with the bathwater or that have got good balance sheets and stable cash flows, if bonds get bid next year because the world is slowing, then some of those interest rate sensitive businesses with really strong underlying cash flows are going to be in an exceptionally strong position.